Hey guys, welcome back to Inventing a Better You. In this video, we will continue the investment series on how to create an ideal investment portfolio. More specifically, we will be discussing the different types of investments. Now, in the investing world, there are many financial instruments you can pursue. However, the four main classes are stocks, mutual funds, exchange traded funds, and bonds. So I'll be briefly going through each one of these instruments and tell you the pros and cons. Without further ado, let's jump in. All right, guys, so let's begin with stocks. So what are stocks? Well, stocks is a general term used to describe ownership in the assets and earnings of a corporation, and that's usually in the form of shares. So in simple terms, by purchasing stocks of a specific company, you then own a fraction of that company. So if you're wondering how is profit made, well, if the share value of this underlying asset increases, that drives the stock's price upwards. The other option is if the stock pays out a dividend or a fixed interest. So some companies choose to give this, others do not. It's completely up to them. And the dividends can be paid either quarterly, semi-annually, or annually. Now, let's go over some of the pros of owning a stock. Well, the first pro is that stocks are the most liquid out of all assets. So that means they can be easily converted to cash whenever you want to sell it. The second one is the profit. So stocks have the highest upside for profit potential because they experience the largest fluctuations out of all investment instruments. And the third pro would be the diversity. So you can select any number of stocks in a sector. This way you obtain very broad market coverage. So now that we've gone over the three main pros, let's look at some cons. Well, because they have the highest fluctuation and the highest potential for the upside, that's also a risk because with high level of upside, you can actually have a high level of downside. So you can lose a lot of money while you can gain a lot of money. It really depends. The second one would be the direct involvement. So stocks require individuals to be constantly aware of changing markets and critical news that influence the buy or sell recommendation. So this can be a very time consuming process that requires a lot of daily input. And lastly, I would say taxation. So depending on the type of account your shares are held in, so registered versus non-registered account, TFSA versus not, taxes can significantly impact the gains. So keep an eye on taxation rules. So that's about it. Let's move on to mutual funds. All right, so what's a mutual fund? Well, mutual funds are basically a collection of stocks and or bonds put together under one holding. So as an investor, you would buy shares of that holding, which would then give you exposure to all underlying stocks or bonds. So to give you an analogy to make it easier to understand, say you have a basket of different fruits. The mutual fund is the basket itself, and the different fruits are the stocks, bonds, etc. So you're purchasing the basket with everything in it. Okay, so how is profit earned? Well, profit can be earned if the fund's holding increase in price, thereby increasing the share value. The fund sells its securities and use some of the capital to pass it on to the investors. Or C, if the fund pays out dividends on the stocks or interest on the bonds. Now, let's go over some pros of owning a mutual fund. First one will be diversification. So having ownership in multiple stocks will reduce the risk of large losses. Second pro will be liquidity. Just like stocks, mutual funds can convert your shares into cash upon request. Third one would be management. So most mutual funds are actively managed by professionals, which is a very good thing. And lastly would be passive individual management. So since these mutual funds are actively managed, you don't have to worry about all the daily news about ups and downs of a certain corporation. They do all the managing for you, okay? So those are all the pros. Now, in terms of cons, the first con would be the cost. So buying shares of a mutual fund usually comes with a yearly management fee. It's called the MER, and a front end load, which is a fee that you must pay when you buy or sell your shares. So that's the big problematic. Two is the small gains. So if a fund is too diversified, dilution occurs. So practically any large gains made by a few corporations will be offset by the others, which let's say don't make any profit. So in the end, the share price of the mutual fund would barely move. Another con would be taxation. So when you sell a share, capital gains is capital taxation on the gains are triggered. This is the same thing as in stocks. And lastly, would have inadequate management. Now, while funds are managed by professionals, like previously mentioned, it's not always in their interest to satisfy the shareholders. So try and spot reports on what type of actions the management takes. If they're selling all their shares, it might signal bad news. So always be on top of that. All right, so we're ready to move on to exchange traded funds. All right, so what's an exchange traded fund? Well, it's basically a security that follows an index, commodity, bonds, or a multitude of assets. So, in a sense, they are very similar to mutual funds. However, there are a few exceptions. ETFs tend to have much lower management expense ratios and they have a passive management style. Now, how is profit made? Well, just like mutual funds, if the share values of the underlying asset increases, then the ETF share price also increases. And if some of the underlying assets choose to pay dividends or interest in case of bonds, then the ETF will also pay this particular dividend yield. Now, what are some of the pros of owning an ETF? Well, the first one is diversification. So just like mutual funds, if you have ownership in multiple stocks, that would reduce the any sort of potential large losses. Second one is liquidity. So ETFs are much more liquid than mutual funds and can convert shares into cash instantly. There will be management fees. So ETFs usually follow an index, and as such, no active management is required. And that's tied with the fourth point, which is extremely minimal individual management. So indices are usually stable and barely exhibit high fluctuations. As such, active management is not necessary. So the fees are also very low. And lastly, it's the low MER, the management expense ratio. So as I previously mentioned, due to the lack of management, these ETFs tend to have the cheapest MERs. So anything below 1% a year is ideal. Now, what are some of the cons of owning an ETF? Well, the first is the small gains. Just like mutual funds, if the underlying index is too diversified or broad, dilution can occur. So large gains are offset by the other company's losses. Two would be taxation. So when you sell a share, capital gain tax is triggered. And three is low dividend yields. Now, while dividend yields can be decent, they don't compare with some of the high dividend yield paying stocks or mutual funds. And that's about it with ETFs. Now let's move on to our last class, which is bonds. All right, so what are bonds? Well, bonds are fixed income instruments that represent a loan made by an investor to a borrower. Now, in simple terms, bonds are just loans where you're lending money to an organization and that organization in return promises to pay you a fixed interest for the entire term of the loan. So how is profit made? Well, first, bonds pay out this fixed interest either quarterly, semi-annually, or annually. And second, if you manage to hold the bond until its maturity, basically the end of the loan, you will receive back the original investment. Now, be wary because the term of maturity can be quite extensive. It's anywhere between a few years up to 30 years, depending on which bond you're holding. So now, what are some pros of holding bonds? Well, the first one is that they typically suffer much less volatility than stocks. Two would be they provide a steady source of income through the fixed interest rates. Um, Three would be the lender, so you basically receives back the original amount, as I mentioned before, when the bond matures. And lastly, bonds are universally rated by credit agencies, so therefore there's more assurance when picking a high quality one. If, for example, the Standards and Poor credit rating exists for that bond. And go over some cons of owning a bond. The first one is that bonds prices are directly influenced by changes in interest rates or changes in the credit rating of the organization that issues these bonds. So if the interest rate, for example, increases, bond prices will drop. Or if the credit agencies downgrade the rating of the organization that issued the bond, then the bond's price again can drop. Now, another con would be if the company defaults, so basically going bankrupt, you can lose all the money you've invested. For that reason, it's usually recommended to invest in bonds issued by banks or by federal departments. Another con would be the large sum of investment needed. So typically, you need way more than $1,000 to invest into bonds. And lastly, would be that they're less liquid than stocks. So they typically require middlemen to buy or sell. Okay, all right, guys. So with that, it brings us to the end of the video. So please join me in the next video where I'll be discussing what to look for when selecting an ideal mutual fund with a real case example. Probably wondering why I picked a mutual fund instead of stocks. I chose to show you guys the mutual funds first because they're much easier to select for. They have predefined criteria that you can follow. Whereas for stocks, it's a bit more of a qualitative analysis. The quantitative side, it's for advanced investors, and we're going to go over that later on in the series. All right, have a good one.